What if I told you that the idea of every single bank in Japan using XRP was not wrong? It was just early? Most people heard that prediction for 2025, saw that it didn't fully happen on the public level, and immediately wrote the whole thing off as hype. But what if the real story is only just beginning and 2026 is where everything starts to make sense? Today, we're going to talk about something that could change the way you look at Ripple, XRP, and institutional adoption forever. Welcome back to We Are Cosmic, the channel where we don't chase hype, we chase understanding. If you're someone who wants to know what is really happening behind the scenes in finance and crypto, not just what the price is doing today, then you're in the right place. My goal here is simple: help you think like institutions, not like emotional retail traders. Now, before we go any further, I want to say thank you. Every subscription, every comment genuinely helps this channel grow. These small actions tell the algorithm that this kind of deep financial discussion matters. So if you find value in this video at any point, take 1 second to support the channel. It really does make a difference. Let's set the stage clearly. There was a strong narrative that by the end of 2025, every major bank in Japan would be using XRP. That exact timeline did not play out publicly the way many expected. And because of that, critics jumped in fast. They said it was fake. They said it was hopium. They said Ripple had no real traction in Japan. But here's the problem with that thinking. Real financial adoption does not move on Twitter timelines. It moves quietly, slowly, and then all at once. What we are seeing now is not failure. It is delayed confirmation. In this video, I want to walk you through why the optimism around XRP in Japan is not only still alive, but arguably stronger going into 2026 than it has ever been. We're going to connect real dots between Ripple and some of the largest financial institutions in the world. Not rumors, not price predictions, real relationships, real incentives, and real strategy. We'll start with the banking and partnership side because that's where the foundation is. But I strongly encourage you to watch until the end, because later we're also going to touch on something more unusual, something borderline conspiratorial, that has a lot of people scratching their heads. Whether you believe in coincidences or signals, it's definitely interesting, and it adds another layer to this story. One of the most important things to understand early is this: just because something is not loudly announced does not mean it is not happening. In fact, in traditional finance, silence often means preparation. Banks do not move like crypto influencers. They do not announce experiments before they are safe. They do not rush to be first. Their biggest fear is not missing upside. It is making a mistake too early. And this is especially true in Japan, where regulation, reputation, and long-term planning matter far more than short-term headlines. Recently, Ripple announced a brand new partnership with one of Japan's top 3 largest banks. That alone should make you pause. This is not a small regional institution. This is a major player. And what makes it even more interesting is that this now places Ripple in active relationships with the 2 largest banks in Japan. That is not accidental. That is not random. That is strategic. Around the same time, something else happened that most people missed. A Bank of Japan insider posted about XRP and then quickly deleted it. Now, on its own, that might not mean much. But when you zoom out and look at the broader picture, these little moments start to feel less like noise and more like pressure building behind the scenes. So the real question becomes this: were those early XRP connection charts wrong, or were they simply ahead of their time? Ripple announcing a new partnership with one of Japan's top 3 largest banks is not a marketing headline. It is a structural signal. Large banks do not test core payment technology casually. They don't try it out just for fun. These decisions go through years of internal discussion, risk analysis, regulatory review, and competitive benchmarking. By the time a partnership becomes public, most of the work has already been done behind closed doors. This is where those old XRP charts and documents come back into the conversation. For years, the XRP community circulated charts showing Ripple connected to massive financial institutions: HSBC, Santander, SBI, American Express, Accenture, CME, MoneyGram, and others. At the time, many people laughed at these visuals. They called them fake. They said it was pure hopium. They said Ripple fans were connecting dots that didn't exist. But here's the uncomfortable truth. Many of those connections turned out to be real. Not all of them were live products. Not all of them were active at the same time. But relationship does not always mean immediate usage. In traditional finance, a relationship can mean joint research, pilot programs, internal testing, or future readiness. Crypto investors often misunderstand this because they expect instant results. Take Santander as an example. For years, it was rumored they were working with Ripple. People doubted it. Then slowly, confirmations came out. Same story with SBI in Japan. Same story with MoneyGram in the past. Over and over again, what was dismissed early ended up being validated later. This pattern matters. What it suggests is that Ripple has been building deep institutional relationships for a very long time, much longer than the market gives them credit for. These banks were not waiting to see if XRP would pump. They were waiting for regulation, clarity, and safety. This also explains why so many of these documents appeared early. They were not roadmaps for public launch. They were snapshots of internal conversations. When the XRP community found them, the mistake wasn't believing they were real. The mistake was assuming they meant immediate adoption. Finance does not work that way. Another important point people miss is secrecy. Banks do not want competitors copying their strategy. If a major Japanese bank quietly gains an advantage using Ripple technology, the last thing they want is to announce it before it's fully implemented. Silence is a weapon in finance. That's why so many people get confused and frustrated. They ask, if Ripple is working with all these banks, why aren't they shouting about it? The answer is simple, because the banks don't want them to. Ripple is not selling meme coins. They are selling infrastructure, and infrastructure moves quietly. This is also why a deleted post from a Bank of Japan insider raises eyebrows. It doesn't mean something magical happened overnight. It means conversations are happening internally. It means XRP is being discussed at levels most retail investors never see. And when something is discussed but not yet announced, deletion is often safer than confirmation. The bigger takeaway here is this. Japan is not rejecting XRP. Japan is positioning itself. When you see partnership after partnership coming out of Japan, it directly contradicts the narrative that XRP adoption failed. What actually failed was the unrealistic timeline people put on institutional finance. The reality is much more bullish, just slower and more disciplined. To understand why Ripple and XRP partnership stayed quiet for so long, you need to look at the regulatory environment of the last few years. Especially in the United States, crypto became a legal minefield. If you were a crypto-related company, you weren't rewarded for innovation. You were punished for visibility. Lawsuits, investigations, and regulatory uncertainty made one thing very clear: being public was a liability. Now ask yourself a simple question. If you were a global bank, heavily regulated, reputation sensitive, and risk averse, would you announce a blockchain partnership while regulators were actively attacking the industry? Of course not. There was no upside and massive downside. This is why so many institutions chose to wait. Ripple could have had products ready. Banks could have been testing XRP-based liquidity solutions internally. But going public would have made them targets, not just legally, but politically. No CEO wants to be called before regulators to explain why they are experimenting with unapproved technology. So instead, they did what banks do best. They prepared quietly. This also explains something that confused a lot of people: sudden narrative flips from powerful figures in finance. Take Jamie Dimon as a perfect example. For years, he openly criticized crypto. He called it useless. He dismissed it as hype. Then suddenly, his tone changed. He started talking about blockchain technology as inevitable. He said the experiment phase was over. People asked, why did he flip? The answer is simple. He didn't flip, he finished preparing. Public opposition often gives institutions cover. While crypto was bad publicly, it was safe to research privately. Once clarity improves and competitors start moving, the narrative changes. Not because beliefs changed overnight, but because incentives did. This is how institutions manage risk. Another factor people underestimate is competition. No bank wants to be the first one through the door. The first one gets hit with all the questions, all the lawsuits, all the public fear, but no bank wants to be the last either. Being last means losing customers, relevance, and market share. So what do? They wait for a signal. That signal usually comes from regulation, from another major institution, or from a region willing to move first. Right now, Japan is acting as that signal. Japanese banks are stepping forward and saying, we're ready. That gives cover to others. Once one or two major players move publicly, the rest can follow without absorbing all the risk. This is the snowball effect everyone talks about, but very few understand. It doesn't start at the top of the hill with hype. It starts slowly, almost invisibly with preparation. Then suddenly, it starts rolling downhill, and once it does, it cannot be stopped. This is why timing matters more than announcements. XRP doesn't need every bank to shout its name. It needs a few credible institutions to validate the model. Once that happens, the rest follow out of necessity, not excitement. And this brings us to a critical mindset shift. Many investors focus on price action and assume that price reflects reality. Institutions don't think this way. They focus on infrastructure, efficiency, and long-term cost reduction. If XRP solves a real problem better than alternatives, price will follow eventually, not before. This is also why looking at short-term charts can be misleading. Charts reflect emotion. Adoption reflects intent. And intent is what drives long-term value. Many people judge an investment purely by what the chart looks like today. XRP is down 5% this week. It's doomed. XRP is flat. There's no adoption. That's a mistake. Price is a short-term reflection of emotion, fear, and hype. It is not a long-term signal of value. Institutions think differently. They don't focus on daily or weekly price movements. They focus on who the partners are, how the technology works, and what problems it solves. This is why XRP's long-term story is so compelling. Even if the price seems stagnant, Ripple has been quietly building partnerships with massive institutions, improving infrastructure, and preparing for adoption cycles that will unfold over years, not months. Let's put this into perspective. Imagine two scenarios. Scenario 1, XRP price doubles in a week due to hype, but has no new institutional adoption. Short-term gains happen, but long-term sustainability is questionable. Scenario 2, XRP price stays flat for a year, but during that time, multiple major banks integrate XRP for cross-border liquidity. When adoption is public, the value and capital inflow could be massive, far beyond what hype can generate. Which scenario sounds more realistic for long-term investors? The answer is scenario 2. This is how institutions think. Fundamentals first, price second. Charts, indicators, and short-term price predictions are tools, not gospel. They show probabilities based on historical data and emotion. But even the best chart cannot account for a bank quietly onboarding XRP behind closed doors or a government using XRP for liquidity solutions. That's why focusing only on price can make you miss the bigger picture. For example, XRP today looks very similar to where it was in 2017 before it exploded. Many people point to this and say, it's a repeat, it's too late. But if we focus on what's actually being built, the comparison is misleading. In 2017, adoption was limited and speculative. Today, real institutions are on board. The difference is not a chart pattern. It's real-world utility and partnerships. Another important point, long-term value is built through network effects. Ripple's adoption is not just about banks using XRP, it's about creating a network where liquidity flows faster, cheaper, and more transparently. Once a few key institutions start, others cannot ignore it. They either adopt or risk losing clients who demand these modern solutions. This is how long-term capital moves in financial markets. Let's not forget risk management. Institutions measure everything against potential downside. That's why banks were slow to announce XRP partnerships. They had to ensure compliance, security, and regulatory safety. Once those risks are mitigated, adoption accelerates. That's exactly what we are seeing with Japan. The snowball is starting to roll downhill. So here's the takeaway. Charts and price are temporary snapshots. Fundamentals and partnerships are the long-term story. If you want to think like the big players, focus on connections, utility, adoption, and infrastructure. That's where real money flows. Price will eventually follow. Now let's shift gears slightly. I want to talk about something that might sound unusual at first. The patterns, codes, and signals popping up around XRP adoption. This includes numbers like 589 showing up repeatedly in multiple announcements, images, and posts related to crypto projects. On the surface, it might look like coincidence, but for those who follow crypto closely, patterns are worth noting, especially if they repeat across different credible sources. First, let's clarify one thing. I'm not saying these signals guarantee a price move or adoption. That would be speculation. What I am saying is that repeated appearances of the same number, concept, or reference across multiple official channels suggest intentional messaging or at least a common alignment of communication. In finance and crypto, messaging matters. Banks, institutions, and major crypto firms often use subtle signals to prepare the market or communicate internally without causing public panic. Take the example of the 589 number. It appeared in a New York New Year's display, was referenced by MoonPay, and then used by a former CFTC commissioner in a post about XRP. Most retail investors might dismiss this as random, but from an analytical perspective, 3 independent but related sources using the same number repeatedly is worth tracking. Patterns don't guarantee outcomes, but they can indicate coordination or planned sequences in marketing, tech deployments, or public awareness strategies. This is where we need to apply the institutional mindset again. Large organizations rarely act randomly, especially in regulated industries. If multiple credible players use the same signals, there's a reason, even if it's simply to align internal teams or prepare the public subtly. Analysts often call this forward signaling. It's a way of shaping behavior without outright announcements. Another point, crypto is still a new industry. Unlike traditional banking, where communications are extremely formal, crypto firms can experiment with subtlety, codes, and messaging. For example, early product launches, partnerships, or liquidity tests may be hinted at through seemingly cryptic messages. For long-term observers, understanding these signals is part of the game. The key takeaway here is context matters. Numbers like 589 are not magic, and they are not investment advice. They are a pattern to monitor. Over time, repeated signals often coincide with adoption events, product launches, or partnerships that were quietly prepared. That's why seasoned analysts watch these patterns alongside fundamentals, and because combined, they paint a more complete picture. Let's also remember why this is relevant for XRP. Many retail traders focus solely on price, ignoring infrastructure, partnerships, and adoption. But institutional players notice patterns in communications, pilot programs, and regulatory behavior. If you want to think like the institutions, you cannot ignore these signals. They give hints about market readiness, adoption timelines, and sometimes even internal strategic priorities. Finally, this part of the analysis connects back to the Japan story and the partnerships we discussed earlier. Just as the banks were quietly preparing and signaling internally, the broader crypto ecosystem is signaling adoption trends, tests, and market expectations. When multiple signals line up, partnerships, adoption patterns, regulatory clarity, and repeated messaging, the likelihood of a significant market event increases. First, let's be clear. XRP adoption is not a sprint, it's a marathon. Institutional adoption, especially by major banks, happens slowly. There are multiple layers of compliance, risk assessment, and internal planning before anything is public. But once adoption reaches a critical point, it accelerates rapidly. Think of it like a snowball rolling down a hill. It starts small, almost invisible, and then it gathers unstoppable momentum. Japan is a perfect example. The country has quietly built partnerships with Ripple's network for years, and now top banks are stepping forward publicly. This is a signal to the rest of the world that blockchain adoption in traditional finance is no longer theoretical. It is happening. Once other regions see this, it becomes a domino effect. Financial institutions don't want to be last. They cannot afford to fall behind competitors who are already offering faster, cheaper, and more transparent cross-border transactions. This is why 2026 could be a pivotal year. The groundwork has already been laid, partnerships are already in place, pilot programs have likely been running under the radar. Now the environment is changing, regulation is clearer, banks are ready to move publicly, and public awareness is increasing. All these factors combined create the perfect storm for XRP adoption to accelerate significantly. Another critical point is the long-term perspective. XRP is not just about short-term price moves. Its true value lies in real-world adoption, liquidity, and infrastructure integration. Banks, payment processors, and large financial institutions will adopt XRP not because of hype, but because it solves real problems. Faster settlements, lower costs, and easier cross-border transactions. Fundamentals drive long-term success, and Ripple's network has consistently proven it can deliver. We also cannot ignore the signaling patterns we discussed earlier. While numbers like 589 may seem cryptic, repeated signals across credible sources show that adoption is being orchestrated, coordinated, and carefully rolled out. Institutions communicate differently than retail investors. They prepare, they test, and then they act strategically. Observing these signals alongside partnerships and product rollouts gives us a more complete picture of XRP's growth trajectory. For investors and viewers of this channel, the key takeaway is to think like institutions. Don't chase daily price swings or emotional hype. Focus on adoption, partnerships, infrastructure, and long-term potential. Evaluate XRP based on what it is building and who is using it, not just what the chart shows today. Price will eventually reflect real-world value. It's just a matter of patience and timing. Finally, remember that while the road to mass adoption can appear slow, the effects are exponential once the tipping point is reached. 2026 may be the year where XRP adoption moves from quiet internal operations to visible, impactful partnerships. Japan's banks have already started the process, and the rest of the world will likely follow. In conclusion, XRP has deep connections with top financial institutions globally. Early skepticism about leaked partnerships has proven largely accurate. Banks stayed quiet due to regulatory and competitive reasons. Adoption signals, pilot programs, and subtle patterns indicate preparation for wider rollout. 2026 could be a turning point where adoption accelerates rapidly. So, as always, focus on long-term fundamentals, real-world adoption, and strategic partnerships. If you do that, you'll be positioned to see the full picture of XRP's potential rather than being distracted by short-term price noise. That's the story behind the hype, the charts, and the signals. Ripple and XRP are quietly building the infrastructure that could redefine cross-border finance, and 2026 may be the year the market finally catches up.